Easy as Jesus. I remember
Hello and
that.
welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment, where a Southerner is making fun of my colonial accent, and we have been having a wonderful time talking all things natural resources. My guest today, Chapman Scarborough, Wizard CPA. I first came across your work indirectly, actually, talking about a company that I'm obsessed with now, New Fortress Energy. It came on my radar from my buddy James McKay, who said, you need to talk to this guy, Chapman, because he's all over it. Guys, housekeeping, nothing we say here is advice, okay? Don't be silly. We're just two guys having a chat, sharing our thoughts on the world. Read the disclaimer that will be in the description. And without further ado, Chapman, how are you, sir? What's happening? Tell us a little bit about you, how you got into this space, and what drew your attention to natural resources.
Oh, okay. So how I got into the space that we're probably going to be talking about today, which is New Fortress Energy, was basically sort of a uranium investor who wanted to find some cash flow, real cash flow. So
because you got tired of waiting like the rest of us.
Yeah, I mean, it's a lot of that. And I took a lot of the things that I learned in uranium, which was basically understanding natural resource investing. So JORC reports, 43101s, things like that. And it was just sort of a natural fit, actually. And then I transitioned from there into oil. I made the Petrobras call earlier this year, basically telling everyone, it's like, hey, Petrobras. I was very vocal about that. And
preaching to the choir there, man. It's been one of my best investments.
So yeah, and it's been one of my best investments too. And that does continue to be something of a ride, because there's always a little bit of an update there. But thankfully they raised the fuel prices recently. But hey, I like the management team there, and it's everything's going pretty well. I'm hoping Petrobras is going to transition to like sort of a back burner thing, and something I'm just not going to do, and it'd just be a compounder at that point. And then from oil and natural resource investing, just generally not being impressed with what is out there. Sometimes things are pretty much fully valued.
Yeah, so the S&P at like a 1.9 time earnings yield is like, maybe I can do a little better.
Yeah, I mean, and it would have been great to buy Exxon at 30, but Exxon at 100 is more of an institutional investment rather than something that I'm looking for. And I have a kind of a knack for basically finding a lot of upside. So I think before that,
the upside, if we talk sort of not macro but meso, so we're in the natural resource space. You and I just had a chat around uranium. Where do you see the most upside? If I throw a few things at you, if I say oil, nat gas, coal, uranium, what takes your fancy most out of those in terms, I guess, from upside and then from cash flow? What are your thoughts?
So cash flow perspective is going to be all oil all day long. In particular, where you invest, but basically oil is, that's just going to be we're entering in a multi-year bull cycle for oil. Eventually we are going to get to a point where we can sustain $100 Brent and not have like an economic calamity. I mean, it's happened in the past, but we got to wait for the economy to recover just a little bit, at least to give the market some confidence there. But a lot of these, there's a lot of oil companies that just are, they just print cash at that level. Even the ones in Canada do that.
No offense to even the oil sands.
Yeah, even the oil sands.
I mean, there are some good small caps in Canada.
There is, yeah, oh yeah, there's tons of good small caps in Canada. I mean, yeah, it's but some of them are, I mean, is in a desire to find it integrated. I ended up going to like South America, and you just find these like Ecopetrol or Petrobras that were just like massively undervalued, and they still are. Absolutely. I mean, it's I mean, and even on the dividends alone for Ecopetrol,
over 20%.
It's gone 20, 20% this year alone.
And the peso is strengthening, so it's like this double whammy.
Exactly. So we've gone from like, you got a 20% increase in just the dividend itself, just from the strength of the peso. And just the final 2 dividends for the remainder of this year is a 20% yield.
Yes, sir.
I don't know what I don't know what people want to buy. Okay. You can go out and maybe you can go buy Disney. Okay. Or you can go buy Walmart, or you can buy all of these stupid companies that are trading at a negative equity risk premium. Do the math, folks. We live in a 5.5% risk-free rate world now,
Different
which
world.
means, you cannot be invested in these things because you're not going to be above inflation. I mean, it's sort of like, so, yeah, you can say like, okay, the market's going to bid these things up. Well, great. I mean, but I also like to have a bit of a sort of a guaranteed return. So, I mean, I do like crazy projections. I mean, that's the one thing that I do. I mean, I have a good top line. I have a good top line projection for Petrobras now at this point. So I have a model that I can feed in basically what they sold from their production sales report and what their prices were for the quarter, which they publish because they're very transparent about that. And I can tell you pretty much whether Petrobras is going to beat top line or not. And we're still working on the bottom line, but it's what I do there.
But I mean,
and,
if we're, this is what I'm thinking. If we're
yeah.
right about the thesis about this being a multi-year bull cycle in oil, you want to have either low decline or large inventories, or someone investing eventually in increasing production, where everyone else is just about shareholder returns, and that's good.
Oh my God, you're
for the short term.
Thank you so much. I like you already.
Who's cornering the offshore market? Who's cornering,
exactly
all these drill rigs?
See, that's the thing about, okay, so Petrobras recently lowered the dividend. We all know this is what happened, but this is the deal with that. The management's proposition to the shareholders, including the government, basically, is that we're going to take a quarter of your dividend and we're going to reinvest it into the company. We're going to go up to the equatorial margin and we're going to hopefully find the next pre-salt so that we can continue to pay these monster dividends, not only for the next 5 years, but perhaps the next 15 years. So, to me, that sounds like a great proposition. Now, there's the focus on shareholder returns, particularly at these, you have to have a bit of a longer time frame. So, and I get that, there's sometimes where you're in a company, you're fully valued. You don't think you're going to get much capital appreciation on your equity. I understand that, but I think the most important thing is, particularly for a declining resource investment, is, one, growing proven reserves, which is where the whole thing came about. The name of my little Substack it's just sort of about.
Link will be in the description. Don't worry.
Yeah, link will be in the description, and so that's, when you have a company like Petrobras that is actually growing production, it's probably the only oil company right now that you could say is, over the next 2 to 3 years, is going to meaningfully grow production, and grow production so much to the point that I've actually had some colleague oil investors who are so concerned that Petrobras could be growing production too much, and that we might actually lower the price of Brent because we're going to be pumping too much oil, which is possible. I think it's a little scary. I think that's a little too much, but I mean, that would
need to be a lot.
Let's just cross that bridge when we get there. I mean, I don't know. But so, and even then, it's the real future's in offshore, obviously. I mean, you couldn't pay me to invest in the Permian right now, or really anything on an onshore asset, unless it's like natural gas.
What about vital energy? It's in that space, but it's been beaten to a pulp, and they do have a lot of reserves. Just curious.
I think I've heard of this one before. Where is Vital?
Okay, Vital, VTLE ticker.
VTLE, yeah.
Yep.
Okay, where are they located? Let's see here. I've heard of this one before, but yeah, it's
large amount of reserves. Caught my attention. Josh Young has done a lot of work. He's disclosed a large position in the co.
It's a perfect. I mean, it's cheap.
It's
I
yeah,
mean,
it's very
it's
cheap on a, let's say, NAV to reserve ratio.
yeah, and price to
Maybe
earnings as well. I
yeah,
mean, it's really cheap actually.
yeah. Maybe you'll
Um,
maybe you'll take a
that's
look.
something to look at. I mean, Josh Young is a bless his heart. He did fade me pretty hard on Petrobras, but we get along just fine, I'm sure.
A
Um,
transocean as well, yeah. But we
oh, and yeah, and Transocean, Jesus Christ. I mean, I look,
he's a good guy. We buddies. It's all good, Josh.
yeah. So everybody's got different opinions. I mean, I understand where people are coming from on why you take a look at Transocean to be like, oh my God, are you insane? Well, yes, I am a little insane because I'm an accountant with an imagination, which is kind of a dangerous thing
Ooh, ooh, ooh.
sometimes.
Yeah.
Ultimately, if you believe in the offshore cycle coming up, Transocean is your bet there. Everything else
Yeah.
is frankly just a waste of time
Waste of
because
time. Ooh, be cool.
it's all deep water. Okay. These days, if a jackup rig from Valaris meant anything cool or could do anything special anymore, then that would be great. But everything is now ultra deep water. Who has the most ultra deep water ships? Transocean. Can you buy new Can you get new ships? No, you can't. So they're going to have to
Not for the
take
next 2 years at least.
so they're going to have to take these stacked rigs and they're going to have to put them in shipyards, bring them up to, snuff in modern service. And Transocean is the only company that has the assets to do that. So if you believe in the bull cycle for deep water, then everything else is just, I mean, you can diversify if you're worried. Obviously, who knows?
Do you like OSVs as another little play in there?
Um offshore
Somewhat,
services, right?
yeah. Also, offshore
Yeah.
vehicles like
I
transport
mean,
going from
offshore.
side
So
borders of the
so
world.
yeah, yeah. So if you're like into pipelines, that's like a naturally great investment for you because they're always in revenue. I mean, they're there. They're pretty stable. You don't necessarily might not get the growth potential. I mean, for there, it's up to you. It's a different style. I think that's a different style of investment for someone. If you're in sort of the high risk, high reward camp, but you do like months of due diligence, like I do. I mean, I'm pretty comfortable with Transocean. I don't have a position right now because the market went crazy and decided to basically bid the damn thing up all the way up to $8, which is a bit expensive right now.
I was
But if
happy.
it
Yeah,
pulls,
I got some leaps in 21. So yeah, that was good. Now let me ask
I
you,
mean,
you're a
look, it's
CPA. So what happened?
Transocean.
Let's
Yeah,
say,
I mean, Transocean's going to $45. Just tell that to you right now. So
okay, there's a I'm gonna have someone edit that sound bite and then we'll play it back
oh,
in
good.
I told you so. So
Yeah, exactly. There you
so what
go.
happens if in the event of a bankruptcy, my admittedly very naive thesis was, okay, well, this is the value of the assets has been written down.
Mhm.
I reckon a book value is X, let's call it, I don't know, 15, $14 at the time.
Mhm.
And this thing was trading around $3. So I'm saying, look, if you take out all the liens, the second tier, blah, 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 the capital stack, there's still going to be enough for shareholders to get paid out what I thought at the time was more than the share price. Tell me where I'm going
Mhm.
wrong. How do I look at that? How am I supposed to
I
look
mean,
at that?
you're not wrong, and that's where I thought, and that's where I kind of just disregarded the bankruptcy. The people that were saying like, oh yeah, you've got all this debt. Like, okay, well, the first thing I said to them, well, okay, if the day rates go to where they are currently projected to go by December of this year, where they say, so if they achieve that, they're fine. They can service their debt at that point going forward. And then the bonus that you get with rig going forward is then reactivating those drill ships, of course. But having said that, yes, you're totally right on the asset valuation. I mean, that was sort of what I was looking at. I was like, yeah, what will happen in some sort of if there was a true solvency situation, you'd have basically creditors getting a lot of shares. There would be a lot of dilution. It would suck, but the company would be fine. And yeah, it would ultimately probably ruin the terminal valuation by probably $20 if I had to guess. But that's a wild guess. Just based on, the amount of debt and how much, share issuances that you would have to do. They would probably do a lot of converts or something like that, if I had to guess. And converts just are, those are never good for market valuation, because the market
Denominator
hates converts.
grows ever so slightly. Yeah.
The market hates them. I mean, that's some of the problem that Peabody's having right now. But I mean, the most important thing with Transocean is that the really bad debt deals, when they were sort of, I mean, it's important to remember that Transocean never went bankrupt. All of their other, competitors did. So,
And a lot of people see that as a negative because the balance sheet hasn't been cleaned and tidied up, and a lot of people were playing the, let's say, the nobles and the diamonds and the whatever, where they've cleaned up the balance sheet, and people are like, okay, so now we've got all this steel value that's been written down, and we get that for free with the upside of these day rates going where we think they're going, which I get. I guess from the other side, you're looking at it, and I have looked at this and say, well, if you really believe where the day rates are going, that levered balance sheet is kind of torque to the upside.
Oh God, it's totally torque, because that's the problem with what happened with all the companies that went bankrupt. You end up having to sell assets, and you have to sell assets that have like some value, because there's going to be some creditors that just want out. All right. So, you have Transocean that has all of these stacked ultra deep water ships. They're sitting in the Med. They've got some down in the Caribbean, I believe. They're just sitting there, ready to go. And they never had to sell those assets for scrap or whatever the hell, they would have having to sell them for, or getting rid of some of their more modern day rate ships. They're more modern, like the 7th generation ships or something like that. I think we're in the 7th generation. I'm pretty sure. I think they just got their first 8th generation. So, it's threading an eye of a needle. Yes, totally. Yeah. And for some people, they just can't handle that level of risk tolerance. But for me, I mean, I'm pretty comfortable in that area, because I mean, I have a very good model that can project rigs earnings. And I knew that if the day rates, I had to figure, I think it was like 430 is just the average of what they had to go to, and they would be fine. Because basically, once you cover cost, I mean, this is why the rig is such a wonderful business. Basically, once you cover cost, everything above that is just pure profit. So
fixed cost, and it's all gravy from there.
Yeah.
So are you looking, if we wrap up oil and saying, where are you playing it the most, through producers, some of these cheap LATAM fully integrated, or offshore?
I mean, I definitely like the LATAMs integrateds. I really like them if they have offshore. So that's Petrobras, and that's Ecopetrol. In terms of, I mean, I'm a little unconvinced on Guyana, like additional resources in Guyana, which is what's currently being drilled for. There's a couple in there that they're speculative. I'm not an petroleum engineer by any stretch of the imagination, so this is all, just take this with a grain of salt. But I mean, having looked at some of those, I was just sort of looking like, I'm not liking these dry wells that I'm seeing, and I'm not liking this, this oil that's not showing up. And just because if it didn't show up over here and you're pretty much looking for it in the same area, I don't think it's going to show up 5 kilometers down the ocean. So maybe it does, maybe it doesn't. I don't know. It's a bit more,
it's a question mark over Guyana, which is all the rage.
I mean, oh, of course. I mean, it just depends on where you're able to drill in Guyana, because it's pretty clear that all the good stuff is off the shelf. So you get really deep down. And I think there's been some exploratory drilling closer to shore, or, I mean, it's not super close to shore, but basically, but it's just not really coming up with much. So,
so we like the fully integrated, ideally with some
I love exploration
upside.
Yeah.
All right. Let's talk about gas.
Yeah, gas is
Because
go
this
on.
is,
Yes,
I don't understand gas. I'm scared of gas, but I do
you should be.
I
You
do
should be
understand and
scared.
like steel
You should
value
be.
and
Yeah.
infrastructure. So if a company has spent billions in capex
Mm-hmm.
and I have the opportunity to buy it, where the market cap is roughly 5 billion and the capex has been 5 billion in terminals and blah, blah, blah. And that capex has been completed and everyone
Mm-hmm.
else seems to be extrapolating that same capex out into the future. But I'm saying, wait a minute, management is saying they don't need to spend that anymore. That can go to cleaning up the balance sheet and then eventually to shareholder returns.
Yep.
What company am I talking about? Am I going wrong? Give me your thoughts.
We are, of course, talking about New Fortress Energy.
Absolutely.
Now, you should be scared of gas. You should totally be scared of gas.
I am. I don't play in
Natural.
that space.
You should be scared of natural gas.
Okay.
LNG is a different story.
Ooh,
Totally, on the other hand.
Tell me a story, Chapman.
So the purpose of liquefied natural gas is to take natural gas from where it is abundant and cheap to where it is expensive and not cheap and not abundant at all. That could be Europe. That could be areas in Brazil. That could be Puerto Rico. That could be Jamaica. That could be Nicaragua. That could be just about anywhere you want a more ESG friendly investment. And you don't necessarily want to build a coal-fired plant because it's coal and natural gas is much cleaner burning. And, importantly, it's cheaper than diesel in a lot of situations, because remember, you don't have to put natural gas through a whole refining process. So it's cheaper. I mean, you do have to do some refining, of course. You have to do the whole liquefaction step, and that involves drying and all sorts of other fun technology.
And this is why my very logical government here is phasing out gas, because they just decide they don't like gas. Anyway, that's another story.
I mean, it's great if you want to phase out gas in Australia. I hope you can export it. But that's where the growth is, basically, is liquefied natural gas, because one, it's you can get it past the ESG people, because
it is a lot cleaner
than coal. Yeah, it burns, and it has half the carbon intensity, and it burns a lot cleaner too. And thanks to the liquefied, this is where we get into NFE, basically. New Fortress Energy. A lot of people do not understand this company. It's very hard for people to understand. And if I could be generous, I would say that New Fortress Energy doesn't help either. They don't really do a good job explaining it. I wish they would stop talking about the damn adjusted accounting numbers. I don't understand why.
It does scare people a little bit, I suppose.
Well, yeah, particularly when you're in the natural resource space, I guess a little bit, where I would hope that there are more people that are just expecting IFRS or proper GAAP, and not this Silicon Valley adjusted accounting bullshit. So because they don't need to talk about that anymore. I mean, the company's profitable. It's actually quite profitable. And if anything, if you were to extrapolate earnings going forward, we're actually trading at, like, I think 12 times earnings or something like that.
So tell us where. So if we go through, actually, this will be quite instructive. Let's do this. Let me share my screen and let's just bring up. Okay. All right.
Cool. Oh, you use TIKR too.
Right.
You use TIKR too. I like that. This is a good platform. TIKR, actually.
It's not bad.
Yeah.
Okay, so
it could use a little help, but yeah, go on.
Yeah. So here we've got analysts, which does not match up with what management are projecting. We've got EBITDA coming in at 2 billion next year. Apparently that's going to be more like 2.4. But anyway,
yeah,
where we're coming down the line here, where are people going wrong in
and apparently
calculation?
So, all right. So problem is with the free cash flow right there. Mm-hmm. If you're looking at that, I mean, they're still projecting basically that the company is going to be investing billions. And while, yes, some of that is going to be happening, it's also going to be slowing down quite substantially, probably more so than that. Now, maybe this could be some new analyst updates based on the conference call that they had last time.
No, they haven't updated it, man. I'm telling you, they haven't read the annual report. Yeah. They haven't, they literally just didn't look at the first, I don't know, 1 or 2 slides where management have said, You know, this
Mhm.
CapEx, it's going from like 1.5 to like
Because there should
240, which
be,
does
there
seem
should
low, I
be.
admit.
I mean,
Um,
they should have CapEx spending on here. Where is it?
it is, here we are.
Yeah, there we go. Capital expenditure. Yeah, there you go. So, I mean, they're still, expecting the company to basically be spending quite a bit more. Probably to the tune of about $500 million more than the company's probably going to be spending. And even if this was true, the revenue projections are probably coming in low. I mean, you have like you've got I mean, a little bit here and there, but I mean, honestly, it's they are, and even then that 4 billion might be actually low. I don't know off the top of my head, but I mean, you've got a company here. What's really not being accounted for in the market is it's this CapEx part here, but it's also the fast LNG.
Okay, so
Because
let's break down the CapEx, then we'll talk about
Mhm,
the business model
sure.
and revenues,
Yeah,
and
yeah.
then we'll talk fast LNG. Of the transcript that I've read from the conference call, like, I don't know, 3 to 4 of the questions were the same question around the CapEx. And where's the CEO is saying, look, here's the deal. We've already paid for 33, 35% of these new terminals, right, coming online. What happens then is, as we start to generate cash flow, the plan is to refinance. So they don't have to spend the CapEx. The bank looks at this as a cash flowing asset. They will then
They're correct.
refinance that, and all that money that for the rest of the, let's call it 2/3 that needs to be spent.
Yeah.
And that is why you're not going to see these same numbers in the CapEx moving forward. So what
Well,
are your
you'll see
thoughts
that in
around?
capital. Well, you'll see that in capital expenditure because capital expenditure doesn't take into account that's just cash that's going out, right?
Yeah.
Now you're going to
But will
have
that
perhaps
become interest
more.
payments if they debt finance?
Potentially, yes, but even
Okay.
then, it's not necessarily going to matter because you're going to just have revenue growth that's just going to be absolutely explosive.
Okay. So let's talk about
Um,
that. Do high gas prices help this company? Do they hurt this company? Well, they're not going to hurt this company, but are they going to make that much difference?
I mean,
What
so
are the drivers of those revenues?
they buy gas at probably about $7 to $10 for million BTU, MMBTU, right?
Right.
And then they sell it for about $20 to $30 per MMBTU, right? So it depends on, they have minimum take or pay contracts going forward through all of their terminals. And they're about to basically bring on the Brazilian assets, of course. They have a fairly substantial offtake with the alumina plant down there in, I think it's Northeast Brazil. And then they're feeding into a fairly substantial natural gas infrastructure in, oh boy, Santa Cartina, or whatever. It's there. That's all I can tell you. So the upside, what is not being accounted for at all in these projections is fast LNG. But having said that, because I know you want to talk about it, I mean, I would say that, yeah, I mean, look, even 46% revenue growth is probably, that's probably about right. It's the next year after that it's like, you think you're going to slow down there. Like, well, no, because you're bringing on a fairly substantial power plant. You've got the final bits of CapEx here that are going to come online in 2025 that are probably going to be more than that. So you could have pretty much back-to-back years of 40% growth in revenue top line.
Wow.
So I'll be totally honest, I haven't completely finished the numbers, but basically when you start doing the natural gas arbitrage calculations, it gets mind-boggling quickly just how much money there is there.
Yeah. And
So
2 points. I want to point out they've been executing well. Look over the last let's call it 5-6 years, their ability
sure.
to compound that growth. What if we go, if Dutch TTF futures do what they did, or somewhere close to what they did in the past, and just have a blow off top? Is the idea for this company to take advantage of that market, with gas not being a global market, being fragmented, and they can get they can get their gas cheaper. They've got the infrastructure, liquefy it, so process it, liquefy it, put it on a tanker, and send it to Europe if TTF goes, above 400.
They could, in theory, do some of that. Yes. It depends on, they have tankers. There's potentially, I think is potentially one, possibly two ships that they could use to go over and get, $300-400 million sort of nice little bonus. Because that's, if TTF explodes, that can be kind of a profit on that, when, you just need the gas and you're basically willing to pay whatever the price, that can happen. The biggest upside there for them may not necessarily be the natural gas deliveries, but the offtake agreements that they'll get from Fast LNG. Because if Fast LNG works,
explain that to me. What is Fast LNG?
So Fast LNG is it's somewhat proprietary. It's not the first time that this has ever been done, but it is the first time that they're just building these things basically in kind of a shipyard style format and sort of putting them on, the idea of putting them on basically an assembly line. So you see this in Pioneer 3, which has already been down at Altamira, and they're going to bring down the other two platforms, which is Pioneer 1 and 2 and 1. And basically what you have there is a liquefaction facility for 1.4 million tons of LNG annually. They are going to be the only company that is going to have any meaningful new liquefaction this year and probably next year. All the new big expansion projects come online in 2025, 2026, 2027 at the earliest. Given the fact that they can deploy this in probably, let's just say 18 months, and they have several on order. They have 2 more units that are going to be put in Altamira. They've got 2 that are being, I believe, under construction in, which is Sevcorp, or no, it's whoever actually built the latest Transocean ship, believe it or not, over in Singapore. They don't talk about them very often. So it's like, it's sort of in the news, and it's like, and none of the analysts ever asked them about it, which is annoying, but whatever. So like, let's just say Japan comes in and wants to secure LNG supply, and they pay NFE for an offtake agreement, and they agree to finance the thing at a nice low rate too. And so then all of a sudden NFE is coming in, and they're now expanding this infrastructure, and they're now doing what they really will hopefully be doing in the future, which is finding orphaned gas assets, areas where it's not good, it's not economical to build a pipeline, let's say, but you could put some of these jackup rigs offshore, and you could take orphaned gas assets and liquefy them. This is eventually what's going to happen down in Mexico. There's a partnership they're still working out with Pemex to develop a field. It's a natural gas field. It will require about 5 offshore wells. At least one NFE unit, or liquefaction unit, 1.4 million metric tons per year per annum unit, is going to go there. I imagine if the field has enough gas, or they can get enough gas out of it, they could put 2. But and when you have that, they're going to be basically untied from Henry Hub, which is great, because obviously their prices are going to be adjusted to Henry Hub. But if they don't have to pay Henry Hub and they have their own supply, they can arbitrage that even more effectively. So, I mean, if TTF goes up, natural gas, LNG prices go up everywhere. Yes, their contracts are adjusted to market. There's other benefits to how they're doing their business, but ultimately what they are is they have they build terminals where they basically have a functional monopoly there. And yeah, they come in and they give you a good price. It's going to be cheaper than diesel. So they save people money, and they bring in a solid supply of fuel that can be of energy that can be relied on, essentially. And they back this all up with take or pay agreements for minimums, basically. So if you are, in some situations, they may even have the generating assets too. So you have the supply to the liquefaction, to the ships, to the terminals, to the generation.
Sounds pretty close to fully vertically integrated.
Yes. And this has been something that has not really existed in the market, where you have
that's my next question. So
yeah,
what is there anyone else doing this? Who is doing this? Because I don't know. And
not
why
really.
aren't they doing this?
Well, because it's just not the way that LNG has been ever been done.
Okay.
The way that you would do an underserved market is you would just deliver them fuel, or you deliver them diesel, or you deliver them LNG, whatever you'd want. But you would never say, okay, I actually want to have the generating asset because I want to be able to monetize this all the way up and down the line. And if you can do that, then NFE can come in and they can beat anyone on price, because they're able to just shave a little bit of margin off everything.
Start to finish. Yeah.
And then they have pricing flexibility that just nobody else has. Importantly, everybody remembers the example of in the way that they do the business, where they have the generating asset, but they do not get into electrical distribution. Take Puerto Rico, for example. Okay. In Puerto Rico, they are in charge of, they have the contract for the legacy generation, and they have a few, probably about, I think, 300 to 400 megawatts of generation that is like theirs. So they'll get the full revenue from that, right? So they do not do the electrical power generation. Let's go march over to Hawaii real quick. And let's remember what happened to Hawaii Electric. Let's also remember what happened to PG and E in California, where the lines basically fell and they caused a fire. Well, NFE is never going to be on the hook for that. Okay, because
so they stop one step short of that.
Yes, because that's where you get into like trouble, basically, where you're dealing with like a bit more, the CapEx becomes like, you have a much higher risk, basically. And the risk is just not worth it. It's far easier just to be the generating source, where you have a firm offtake agreement, firm power purchase plan, basically, power purchase agreement, excuse me, where you know exactly what your revenue is going to be. And for instance, they have adjusted their positioning in the market accordingly. For instance, there was a new law in Mexico that basically said if you're a private operator, you may not get priority dispatch. So they sold their Mexican generating assets to the local utility. I think it was, I forgot what the national utility for electrical generation in Mexico is called, but they sold it to them, but they're still supplying them. So it doesn't matter. It's like, okay, all right, cool. We still got that. Okay. And they're able to do this in a way like, you don't need like a full terminal, right? You can do just trucking, where you just have like a tank of LNG, and they're just, they'll put it on
the logistics, and then once they deliver, it's this, I guess, the state utilities problem.
Exactly. Yeah. So they can do small terminals like they do in the California Baja side of Mexico, or they can do like full, multi-million MMBTU terminals like they have in building in Brazil right now. So
one coming online in Ireland. It's going to be the only one in the country. Puerto Rico.
With a power plant in Ireland, which is great because it's just going to have a firm power purchase agreement, and it's probably going to be a little bit less subject to taxation, like the Europeans love to just tax the damn energy provider. Anyway, I'm not quite as worried about that one. I usually
what's gonna mess this investment up? But what do you think it's worth? I've got my ideas. Some of my models say this thing is triple digits. And then I'm like, well, hang on a minute. Am I just like viewing this through rose-tinted glasses or what? So I'm trying to red team this. How do you see it? What are the potential problems in the future?
The ultimate valuation for NFE depends on how the market is going to choose to value it. I mean, obviously, let me qualify that a little bit more.
If we use like I don't know, historical mean multiples, let's say.
Well, if you use a multiple for a utility or basically an infrastructure utility, this is why Wes was saying on the call, we are an infrastructure company, because he wants a 20 times ultimate multiple, which is what pipelines and utilities and infrastructure companies are valued at. If you're a natural resource play, you pretty much top out, or if you're a resource play, you top out at about 8.
That's what I use.
And if you're somewhere in between, obviously you're at like 12 to 14. So either way, even if you are like this year alone, we're going to be trading at 7 times multiple based on the current price by the end of the year. Next year, we're going to be trading at 4 times. Now, if we just maintain the current valuation, I would have to think that we're basically a double by next year, very least. We haven't even brought on the 600 megawatt Brazilian power plant online yet, and we haven't fully deployed fast LNG because we still have about 2 more terminals after the 2 more that will be deployed next year.
Hard to argue with that. Yeah.
And if fast LNG works, where you can basically come in and you get these firm offtake agreements, like let's just say Japan comes in and they want to just secure supply because they're tired of doing this whole, oh God, are the Chinese going to take their LNG or not? And they just want to be like, no, we want to get a firm supply from somebody. So we're going to come in, we're going to give New Fortress a really nice financing deal. And we're going to take half of the LNG that this platform produces, and this let's just call it a line, or what did they call them in there's something they call them, trunks. No, it's not trunks. It's whatever. Anyway, I'm always at a loss for words whenever I get in front of a camera because I never remember what the vocabulary is. I'll remember it later.
I find that hard to believe, but anyway, we'll call it a unit, whatever.
Yeah, so that unit or production line, let's say. So yeah, and then they go from there, and then they start getting orders for these things, because that's the kicker. The market is not valuing fast LNG. It is basically everything that you see, all of this infrastructure, all of this revenue that you're seeing, these projections from the street are completely disregarding fast LNG. It is assuming that fast LNG just doesn't work at all. Yes, totally, completely. And if it does, hang on to your seat, because this is going to be huge, because LNG is where all of the growth is right now, particularly in the United States, because you got the Permian that's becoming a lot more gassy.
Yep.
And so this gas is going to need to go somewhere. So there's a combination of NFE and basically my favorite tanker play, which is Cool Company, CLCO. And NFE, of course, has their ships. Cool Company is just a pure play LNG carrier. Those are fun businesses because a lot of people don't, particularly if they are in the oil space, where the tankers in the clean petroleum products and the crude tankers seem to function more on the spot rate than in the LNG space. In LNG, you have day rates on these ships. I'm sure there's that in the crude tanker space, but basically these ships are tied to a day rate for like years. And what you really want in an LNG play, in general, is you want assets coming online in the winter, because that's when TTF seems to be going crazy. I mean, you saw what happened just a couple of days ago when TTF had a little spike on the off chance that there was going to be some strike in Australia. And all of a sudden you're seeing like Cherney and NFE and all these other LNG plays that are just going like, wow, it's like we're up 5-10% today.
And given the let's call it the changes in infrastructure to Europe's gas supply over the last few years, as far as I can tell, nothing has changed. Like literally nothing has changed. They've stocked. Okay, they're stocked for the winter. That's great. They had a warm winter last year. They got lucky. And then what? Like, what are they going to do for gas?
Well,
moving forwards.
So basically, the projections that you're seeing for this winter are very, very conservative in that they are basically projecting a warm winter, in my opinion.
They had a record last year. Can lightning strike twice? I don't know. Maybe it can, but
I mean, well, they had a record last year because everyone was like, you had because you just had crazy arbitrage in that. And Cole got a bid in sympathy for that because, we were basically trying to convince the Japanese, whoever else that we could sort of spin the wheels on. Like we told the Japanese, like, hey, help us out here. And so the Japanese end up taking like more Newcastle. So you see like the crazy coal prices go. So coal is sort of in a sympathy play to it's.
Yeah, let's talk about coal before we move on to uranium. It's Christmas is coming up, and all I want for Christmas is coal this year. I love it.
Which is going to happen. I mean, if look, a lot of people have just not realized that coal trades to TTF because it's a substitute.
Yeah. And you don't need the infrastructure. You can just load coal, deliver it, and away you go.
Yeah. So, if TTF goes up, coal goes up. I mean, you see this, like, just take a look at your coal investments, put them on a chart, put them next to TTF, and you're going to pretty much see that it just follows. So if you don't want to be in coal, that's fine. But coal is a bet that, you can have a little bit of extra torque in from it's complementary to a TTF play, basically.
With very nice dividends and
with huge dividends, because these companies have now pretty much all paid off their debts. BTU has a little bit of debt left. Whitehaven is, I mean, these are just, these are cash generating enterprises that are just.
Yeah, prices are going out of business in 3 years.
Exactly. Yes, totally. And that's the thing. Like, here's the big secret, right? So a couple years ago, when everybody thought that coal was dead, particularly in the gap companies in the United States, they had to write down massive amounts of assets. You can't write those back up in gap. You can in IFRS, of course, but not in gap.
The old Miller Energy from Alaska a couple of years ago, that fiasco. Yeah. Anyway, we won't go there.
So basically, if you were to take a look at, like, let's just say Peabody's balance sheet, right? You would assume that they have like 5 years, maybe 7 years of production left. And it's like, no, they have like 20. So it's like the market is pricing this thing at like basically 2 or 3 times, I think, free cash flow.
But like Whitehaven's got nearly 25 years worth of production. Okay, people are worried that the government's going to tax more. Which is an issue, but.
Well, I mean, the government loves to raid. I mean, this is where, you get back into like utilities and sort of the danger of like why I like NFE is because if they have a problem someplace, well, it's like, fine, we'll just pack up our ships and go someplace else. Exactly. I mean, it's like, you've built a little terminal. Okay, great. I mean, you're going to lose a couple $100 million building that, but you can just take your floating storage and regasification unit, FSRU, and then I get these confused because then I'm hanging out in Petrobras land where it's FPSOs or floating pumping storage units or something like that. And then I go back into LNG land where it's FSRUs, and it's like, oh my God, just a floating storage unit. That's what it is. Floating storage and does some pumping, I guess. I don't know. It can
float.
Yeah, it can float. There you go. It's exactly. So they can just take their infrastructure and go someplace else.
So when it comes to coal, are you taking like a basket approach? I know you love Peabody. Why do you love Peabody?
I like Peabody.
Okay, I
It's
got some
cheap.
Peabody. I got some, let's say, Yancoal, Whitehaven, New Hopes in Australia. I've spread my jurisdictional risk a little. I got a blend of thermal, met, coking, or whatever it is that takes your fancy. Where are we at? Are you more thermal?
Okay.
You like
So
met?
I actually like a mixture of all of them
Okay.
in the coal plays. I don't necessarily like to focus just purely on a thermal or a met play because, if obviously steel production goes down or something happens to the world economy, met's going to hurt severely. But, there's still always a need for thermal. But, if you don't have any met with your thermal, if the economy starts to get better, well, then you don't really have that kind of torque there. So I prefer the coal plays that have both.
Hence Peabody.
Hence Peabody. Peabody is also just stupidly cheap compared to everything else. I mean, it's just like the market has just sort of lost I don't think that people understand how to do math. Now, having,
Talk us through
being
this. So I think people are saying, oh,
yeah.
Peabody had a great run when coal was going up. And now coal's come down, so Peabody's not going to do very well. I'm saying, have you looked at the enterprise value of this thing? And we were talking about share buybacks before. Walk me through the maths. Explain this to me.
Okay. So if you're buying back, let's just say 18% of the shares this year, assuming that this is the current price anyway. I mean, there could be more buybacks if coal prices go up, right? Because all the hedges for Peabody have rolled off. They're out of the hedges now. So if the coal price goes up, fantastic. There may be a few hedges left, but I do believe most of their hedges have rolled off at this point. In addition, it's like they have $1 billion on the balance sheet, right? And they're not even really touching that. They're just buying back the shares with
From the
free cash flow. Yes. And they're already buying back like 18% of the shares this year. They're going to buy back more next year. I mean, basically what the management's not really trying to get the price to go up because why should they? We're buying back shares from basically a bunch of idiots that are selling at this valuation.
And the other
they don't know what
shareholders
they own.
Dead set against acquisition or M&A. They just want,
because we don't need it.
Yeah.
I mean, exactly. If you take a look at the proven reserves of the company, there is no need to do M&A whatsoever. There's just none. Now, let's assume, fine. If we have like something that's like stupidly cheap, fine, we'll talk about it. But if it's not stupidly cheap, like we're literally, robbing
cheaper
people
than our own company's shares.
Yeah, exactly. If it's not cheaper than our current production, which is already the lowest in the business for BTU, they can produce, way lower than anybody else can, which basically means that their mines also shut off last. So assuming that, coal goes dead again, I don't know, we'll see. But I mean, either way, it's like there is just a huge margin of safety here. I mean, it's a margin of safety the size of the damn Pacific Ocean. I mean, it's like you can't get any wider than this. Now, yes, there are some people that are worried about this because it's not ESG, and you may have to buy that. You have to understand that you're going into this, and you may never get a bid. That's fine. But
if you're earning your way out every 2 to 3 years, it doesn't matter what happens.
Exactly. And if you're just compounding at this level, like, I don't care. Like it's like the company could honestly afford to raise the dividend quite substantially. I mean, they could go to $1 a quarter, and that wouldn't be a really big deal for them at all. And it's so for BTU, like, fine. I mean, I don't really talk about BTU very often because I don't really want to get people to understand it. I mean, they clearly don't know how to do math. And so it's just patience. I mean, honestly, it just was, I mean, ultimately what will happen is that the company is just going to make massive amounts of money. And there's going to come a point where they're going to slow down the buybacks and they're going to increase the dividends. They're going to have these monster dividends out of BTU, and eventually the market's going to get it. And if they don't, well, who cares? I mean, I have for my price targets for everything I own, BTU I have basically going up, like, not as much this year. I think I've got a $30 price target for year end. It's $45, I think, at 40 or $45 after that, and then I think it's $75 like, let's just say year in 2025. So it's actually the slowest going of anything in my portfolio in terms of like the pace, but it actually will exceed everything that
But when
I
you take
have
into
in terms
account
of like,
shareholder returns, be they
yes,
dividends,
that's just
buybacks and
capital, and that's
things
just capital appreciation on the
appreciation.
shares. So that's, that's just what I think the share price is going to be. Because I mean, and why wouldn't it be that? They're buying back 20% of the shares this year. They're going to buy back probably more shares next year. So half the damn shares are gone.
Gone in two
So
and a bit years. Yeah.
I mean, it's like, what do you want, folks?
That's
Like, just sit back and just, coal isn't going anywhere.
nope.
I mean, and as much as, as look, I have no confidence, and we get into the uranium part of this, but basically I'm invested in coal, and I didn't have the heart to tell this to the people at the nice uranium, basically the SMR conference I went to last year. I didn't have the heart to tell them that, look, I don't think you guys are going to get this done in any kind of a reasonable time frame. So I'm invested in coal.
That makes sense.
Because
this is what my buddy Trader Ferg says. He says, look, nuclear is what we should be doing. Coal's what we will be doing until we get our act together with regards to nuclear. And in there, natural gas will have this little boom boom.
Well, because coal doesn't require the kind of infrastructure that natural gas does.
It's just the lowest hanging fruit, and we need to plug a gap.
Yeah, exactly. Gap. I mean, look, for coal, you pop up to you come up to the dock and you basically just dump it. All right. It's a little bit different. You got to have a little bit more infrastructure for the LNG. Now it's worth the investment, of course, but you got to have the infrastructure for it.
And that takes time.
So yeah, exactly. So you'll have places like Brazil that, because they're more developed countries and they're richer now, they have elected, as a matter of fact, the place that where they're putting the power plant in Brazil, New Fortress Energy, was originally supposed to be a coal plant. But they decided they wanted to do natural gas instead. Yeah. Exactly. So it's just longer, better for the future for them and everybody else. And they have the alumina plant there that has a fairly substantial offtake agreement as well. So because they will be using that in the refining of bauxite and whatever. Aluminum requires a lot of heat power, so got that. But
speaking of which, if we transition, I know we said we're going to do uranium. Let's do uranium last because it's more of a natural transition to go from coal to steel, because met coal, etc. What's happening with steel? Horizon Kinetics is saying everyone's talking about copper and cobalt and blah 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 for the electrification of the world. That's great. You know what else is needed? Steel. Lots of steel. Wind turbines need a lot of steel. We need to make a lot of steel. So on one side, I've got
roads need steel. I mean, bridges need steel. Everything needs steel. Buildings need steel.
But there are a lot of steel companies. I'm invested in one Brazilian company. I'm
good boy.
I was hoping you'd either give me approval or say, hey, get the fuck out.
It's fine. I may have to actually buy it because I mean, the steel thesis happens next year. I like steel.
Tell me why.
But
when everyone's worried about recession, tell me why it happens next year.
Well, ultimately, because you're either going to have the recession or not. China's either going to, you're either going to be building, you're going to have a more stable economy where people are buying steel and doing more infrastructure projects. Basically, steel is a thesis for just before the economy bottoms out, like just after that, is where you want to sort of lever into steel, because then you're at the bottom there for orders, essentially. Yeah. And everything is just kind of upside from that point.
Makes sense. So how do we know when we're at that point? When I see some companies, they already they looked very cheap. Maybe I was a little early.
The problem is that we have to recognize the United States is in tariff world now. So there's a lot of noise there. And for instance, you have Cliffs, US Steel, even Nucor that are coming in a bit above expectations because the tariffs are helping them out, right? Because effectively, if a steel product is made in the United States, and there's a lot of steel products, different classifications of it, but basically it's like this rolled to this thickness with this coating and with like holes in it is a certain product code. I mean, there's hundreds of them.
Yeah, so it's very niche.
So if you make that product in the United States, it can have it. You'll tell the trade commission or whoever else is in charge of it to put a tariff on it if it's being imported. If not, then it doesn't have a tariff. So basically, the products that these companies make are still in demand. They are able to basically still kind of charge something of a higher price for it. While we're in China land, where you have basically iron ore, which is a close cousin of steel, of course, and you get into things like Vale and Vale. It's Vale. I think that's how you pronounce it. I talked to the Brazilians. I think that's Vale.
VALE ticker.
Yeah. So you get into there, and you're sort of seeing like sort of the sideways action in rebar and iron ore in the Chinese futures, Shanghai futures, basically for steel and iron ore. And it's like, it doesn't look good. It doesn't give anybody any confidence that steel is a good investment right now. But then you have, this is a sort of a cider conversation of what's kind of going on here, particularly with Cleveland-Cliffs, which of course made a offer to buy U.S. steel, which isn't necessarily. That's a fun, interesting side story. That is really about Big River Steel 2.
Tell me about this and what's going on with the CHIPS Act. We're going to need all this infrastructure to manufacture chips in the US, and US steel is supposedly going to benefit from that. I don't own any US steel plays yet. Maybe I will.
I mean, it depends on what you think is going to happen with this whole deal, because this is really coming down to Big River Steel 2, because that's 3.3 million tons per annum of steel capacity in Arkansas, crucially non-union, and they can make anything there. It's a mini mill. It's the design of that is you can do piping, you can do sheet, you can do slab, you can do whatever the hell you want. And it is by far US Steel's most profitable segment by several orders of magnitude. And it's non-union. This is a problem for the United Steelworkers. So the working theory is that they have basically convinced Lourenco, if I pronounce his name, let's just call him LG, because Concavez, yeah, I think it's it, but we'll just call him LG, over at Cliffs, to buy US Steel because they want to drown this non-union mini mill basically before it breaks the union, which is what it's going to do. Because once he has Big River Steel 2 online, which is 3.3 metric tons per annum, and it's electric arc furnace, which unlike a blast furnace can be basically spun up and down very, very easily. Whereas a blast furnace, you pretty much have to run those things all the time, full bore, or they don't make money. And you may actually have to make more steel than you get into kind of a crazy situation where you may be making too much steel, and you may lose money there too. So because you're going to have to be producing below you're going to be producing, your cost of production is going to be above the market price. So with that, he will be able to basically shut down, in my opinion, about 3 blast furnaces, Mon Valley and Granite City. They'll be gone. Or the union will have to accept either upgrades to the blast furnaces to make them more efficient, because the Japanese can run their blast furnaces at about a 17% net margin. We can only run ours at about a 5 or 9% right now at the current pricing. So if the Japanese can do it, I'm sure there's ways that you can make efficiencies, improvements. But the unions have always hated that because
that may reduce personnel. So
exactly. Yeah. So Burritt, who is the CEO of US Steel, is very, very close, in my opinion, to being able to basically break the United Steelworkers, because if he, with Big River Steel 2, effectively speaking, almost just under 50% of his utilized production will become non-union. and he will make more money there. And he will basically be able to take steel production away from union plants and put them in a non-union facility. This basically scares the United Steelworkers to death, as well it should be, because this is an existential threat to the union bosses. Not necessarily, it's great for the workers. The workers will get paid more money, but in a non-union plant, they actually get more money than they do in the union plant.
Once again, that pesky free market just seems to.
Yeah, the pesky free market, and actually being paid for work. Because Big River Steel, they get bonuses, because they produce a lot per worker. It's like quite substantially more. We're talking about 700 employees versus 3,000 for the same production. Lovely. So that's what this is all about, basically, with US Steel. And it's probably, I hope it's very important for the shareholders, hopefully BlackRock and Vanguard and the people that actually, the big institutional players that understand this, are going to vote down this deal, because that's what this is all about. They just want to, and it's why Burritt, frankly, US Steel is in a much better position to buy Cliffs than the other way around. US Steel has a much better balance sheet, and they're sitting on over almost $4 billion in cash. So unlike Cliffs, that has no cash, because that's the way that they run their operation, US Steel could buy Cliffs much more easily, but he doesn't want to do that, because then he's dealing with big union steel and all of his leverage that
streamline that SG&A to make it worth the while.
And all of his leverage over the union will be gone, because what happens is you don't want the union to strike. And if 50% of your production is in your most highly profitable facility, then it doesn't matter. Who cares? Okay, great. Guys go strike. We'll shut down Gary. We'll sell Gary to the condo developers. We'll have fabulous lakefront property in Michigan. Very, very expensive real estate, mind you. And we'll just, happily go on our merry way. Or you can accept electric arc furnace upgrades with the adequate personnel reductions, and we can all be happy and move forward. And basically, at that point, the union's broken. So, because it becomes redundant, it's like it's no longer needed.
Well, it's going to be fascinating to watch it play out.
Yeah, so but that is what is going on in steel.
Are you playing?
I'm not playing it
or are you, in terms of steel, do you have any horses in that race?
I mean, I love Brazil right now. I mean, I'll just make that no secret. But I'm also not necessarily invested in steel right now, because I don't think steel is the play this year. My portfolio is been flat for a couple months, because I've basically set it all up to basically have this lovely windfall from a bad European winter, and El Nino just came back, so hopefully that just brings a very cold European winter for me, and I will be so happy. But I think steel is sort of like next year's play, and then copper, and that kind of becomes 2025-ish perhaps. Uranium is also next year as well. So essentially, what's going to happen this year is like the only name I actually really have calls in is New Fortress, and I'll take those profits from New Fortress, and that will be then rolled into perhaps steel plays in the next year, because you're just not going to see you're not going to see the growth in the steel production. There's not going to be the higher capacity utilization really anytime soon.
Whereas New Fortress has got all these catalysts coming on over the next, 30 to 90 days.
I mean, where it's like, you have all the analysts who are like, well, but Wes, you're a CapEx company. You constantly spend CapEx so I don't understand this.
Yeah.
I mean, this is what you do. You spend money. You don't make money, Wes. Wes is sort of sitting there, and it's like, guys, we've spent all the money. Okay, we've got all this CapEx. It's coming online now. Now we're gonna have like lots of revenue. You guys don't understand this, but you spend CapEx. They're analysts, they're sell side analysts. Bless their heart, they cannot handle more than like 2 numbers at a time. You have to handhold them, because I mean, in between drinking their soy milk lattes, I'm sure, they just don't understand, because you can't count on these people.
On the mate, sell side analysts,
Oh, is that matcha?
No. It's
Oh,
tea, Argentinian
ah,
tea. You got to get around it.
okay. There we go.
Maybe you don't.
Well,
You're on the energy drinks. You got enough energy as it is.
no shit. Okay, kind of know.
So uranium,
Uranium.
so I do have exposure to uranium. I've talked about it. I like it for, I don't know, humanities purposes in the future. But
Mhm.
when people ask me, where's your biggest position? I say oil and gas, or mainly
Oh,
oil.
of course, yeah.
So
I have
everyone,
a yeah. Go on,
everyone
sorry.
is all on the uranium hype train. That's great. But you're telling me it's overrated. Let's talk about that.
Quite a few of them are. Um, you have to be there. Look, there's well, it's not two. Let's just say there's a couple different mantras. I'll try to remember them. That I've said for the uranium trade. One, if you are truly in the uranium trade, the money that you will make on uranium will come from a deposit that you haven't heard of yet, because it hasn't been discovered and it's not even publicly traded. Eventually, in the grand scheme of things, there's going to be more discoveries, and there's going to be a big discovery, like let's just say something along the lines of Arrow or something like that. And that's going to be, where you're going to make your money. All of the deposits that you find in the uranium trade today, they're all known. They've been known quantities for over a decade, most of them, with the exception of DASA. But even DASA was discovered like 10 years ago. And it just so happened to be the one area. Well, and it has some issues. And look, and the only reason that DASA was discovered was it just happened to be the area in Niger where the French didn't drill. I mean, the French have drilled everywhere in that country, except that one area where DASA was found. So,
Unlucky.
you could say that, yeah. But I mean, and even then, the French are primarily moving away from that country anyway, which is probably why you have the instability, because they're now going into Uzbekistan and Mongolia for in situ assets there for basically the in situ recovery. So much along the lines of like what.
So you're not a fan of some of these deposits that are close to coming online, supposedly 24, 25. I'm talking the bosses
close.
of the world.
Boss is great. Boss is fantastic.
Global Atomic was supposed to be coming online.
Boss was, Global is great. Boss is good. It's overpriced, but it's good. Yeah. If Boss, you're pulling forward a lot of hope with Boss that they're going to find more uranium. Now they could. They have a large area for their resource, but and they have that was a former uranium one, which was the Russians deposit, and they never quite got it working. And also the fact that we had this kind of fallout with the Russians at the time too, and they ended up having to sell it. And then you had the uranium oversupply around that time. This was about, I think, the early 2010s. If I'm remembering Boss correctly. But yeah, I mean, that was an existing deposit, and then Boss came in and they've rehabilitated it, and it's now finally coming back online. It's a good deposit, yes. It's not I think Honeymoon is like just north of them, or Four Mines or whatever that is. There's a private mine that's like just to the north of them that I think. I mean, I've had conversations with. I don't know if I could say his name. If I can't, I'm not sure if he wants
with someone.
With someone. With he's a CEO of a uranium company, but he worked in that deposit and he found it, and it's actually great. It's a fantastic deposit for an in situ resource. It makes tons of money. It's the one thing I wish that Ross had, but it's not Honeymoon. I think it's 4 miles.
So maybe Duncan will have to, or not have to, but maybe Duncan will buy him out and.
Who knows? I mean, it depends on whether it's a private company. It's whether they want to sell or not. I mean, the thing is like a lot of the best assets in the world are unfortunately private because they actually make money and there's no reason to go public because they don't need the capital. So who knows? I mean, the thing is like once Boss has more money, they could potentially drill around where they are and they might find greater resource. That's the hope. Now, if you are confident in that this team at Boss is capable of doing that,
Great.
then great. But it is a little value. It's a little highly priced compared to what their production is probably going to be.
Yeah, there's a lot of ifs, ands, buts.
I mean, if you got in on a lower price, fantastic, but Boss is a good deposit without a doubt.
Do you give no my thoughts on Denison next gen fission are like
oh boy.
yeah.
Okay, go on.
Yeah. No.
All right, so my thoughts. Okay.
So next gen. The only thing I like about next gen is just the balls of the management team writing themselves these big checks of like,
oh
wow,
yeah, I mean, you
that's
got
a great gravy chain.
I think I saw the joke of like a next gen secretary's car getting pulled, and it was a Ferrari, a Lamborghini Huracan.
Yeah.
It's like
Denison. I mean, yeah,
if they can get it situ working.
Yeah, Denison could do it. I don't mind Denison. Fission is good, but can they actually get this thing to production? I don't know. And it's too hard in Canada anyway, as far as I understand. This is why everything's so far behind in Canada. I don't know what your thoughts on the Canadians are. And then
so there is one deposit in the Athabasca Basin that I do like. Give everybody I don't want to say it publicly because I don't talk about it, but I'll give everybody a hint and just say that it's NXC owns it. So if you know that, then you'll be able to figure it out. Because I don't, so there you go. It's in the know. But it's the only deposit that I think is actually going to get bought in the next 2 or 3 years. It's a lovely deposit. It's probably about 45 million tons or 45 million pounds. And it's close to the surface, and it's very close to Cameco. So in other words, Cameco is going to buy this.
Sell it. They're not going to develop it. Someone else.
Well, because NXC is going to need the money. So they're going to buy this.
Yeah, I guess those Lambos don't buy themselves. Yeah.
Oh, exactly. And ultimately Arrow is going to require money to develop. And they're going to get probably 500 million for this. 5 to 6, we'll see. Cameco is going to need it's going to need an asset to replace Cigar Lake here fairly soon. Because I mean, Cigar Lake is a high intensity. It's a small but high intensity asset. So they mine like 18 or something, a lot of pounds out of it, and it has a projected life.
Yeah, I guess
2027, 2028.
I spoke with Justin Hune earlier this year, and with this new, let's say, recent developments, more of these pounds from the east are going to stay in the east. So where are the west going to get their pounds from? This is a question.
Oh yeah.
Where do you think they're going to get their pounds?
You're still going to get pounds out of Kazatomprom, of course. And God knows how many pounds damn BHP sells out of the
Olympic Dam.
The Olympic Dam, that's it.
I don't think it's that much, is it?
It's more than you would think.
It's a nuisance.
Oh, yeah. They don't even talk about it, but it's actually they sell more pounds than you would think they do.
Okay.
Yeah, but having said that, you're gonna get you're still gonna get pounds out of Canada, of course. There's still gonna be production out of Niger. Maybe not. I think actually Orano shut down their mines there, but Orano is gonna start getting their pounds from Uzbekistan and Mongolia. Kazatomprom Kazakhstan pounds are gonna make it out because Kazakhstan has aligning themselves to China. And
China got a lot of reactors to feed over the next 10 years.
That is where actually I call it bull thesis Mark II, or maybe Mark III. Yeah, I think I forgot which bull thesis I'm on. But basically, China is going to come to an inflection point here fairly soon, where the amount of reactors that they're going to have is going to exceed their annual imports, the requirements for those reactors. So at that point, they will have to actually secure more supply. Now, China has probably a decade of uranium, along with the Japanese. They just keep a huge amount of uranium. It's just what it is. So, there's going to have to be more assets that'll come online. But you'll be surprised, did you know that Urano was looking in Uzbekistan and Mongolia before I even told you? I mean,
Not
there's
well. I guess
there's
since let's say Niger is probably on the back burner for now, and that's
well,
what
I mean,
70%
and
of
that's
their
yeah, and that's
uranium.
why yeah.
That's a fair.
Well,
That's a
it's
fair
not
hole to plug.
it's well, the French have a lot of supply. And the reason that you didn't see a panic in the market is because, frankly, those mines are depleted. They have been operating in Niger for decades, since like the
Yeah,
70s
50 years at
almost.
least. Yeah.
So they are, the French have not just been, I mean, they've never had good luck in Africa. I mean, you can go and you can see the Namibia debacle, where they bought basically a glorified pile of dirt for €1 billion. It was a disaster. Nearly, I think it actually bankrupted Arriva or Rano, whichever one it was at the time. They spent like way too much money. I mean, they just got completely fleeced because they didn't have a good geology team. That somebody just told them, or they basically thought that they were going to be able to mine this, and it turns out, I mean, it's like the most expensive uranium that's ever been mined. I mean, it was like $1,000 a pound. It was something insane.
Socialists
Before
don't
they,
do economics, man. You know
well,
that.
even socialists, you can't even,
Next
the
level.
French. Yeah, I mean, but it took them a while before their French stubbornness finally, they relented and just sort of gave up. So, so they have been looking outside of Africa. Uzbekistan has become sort of a quiet little dark horse of the Japanese are also in Uzbekistan as well. And now we found out recently that the French are in Mongolia. These are basically like state-run sort of private partnerships. They're not really necessarily publicly traded, which sucks. But just I think it's important for everybody to remember that like 60% of, probably even 70% of the world's uranium is a black box. It's just hard to know where all this stuff comes from. And there are mines that, we probably just haven't heard of. And it just is what it is. And one, you just don't need a lot of it too. That's the other thing. Like uranium is
It's such a energy dense
yeah.
fuel that you
Yeah, exactly.
So
So
are you playing it? How are you playing it? Where are you playing it? Those
so you bring
on
Arrow, basically, let's say. And that's going to be quite a bit of supply every year, probably, more than you think. Then you have production of Kazakhstan, of course, and then, with the other two plays, and then you'll probably find something will be found in Africa, and you've got Boss, of course, that's now coming online too. So, this is probably be something else in Australia that will come online. Probably it's going to be a while, though. There'll be something that's going to be discovered.
There's a lot of anti-nuclear sentiment here, man.
Oh God, I know. Tell me about it.
I don't know. So,
I mean, even if the coalition wins, it's not like they're going to actually do anything.
Correct. Yeah, and you got 3-year election cycles, which makes it hard for you to do anything.
I mean,
what about
based on,
speaking of Australia? What about Johnny Borshoff down there in Namibia doing this roll up with Deep Yellow?
Why? Oh, sheesh. Okay. So Deep Yellow is it's all right. In Namibia, you have two classes of assets in Namibia. All right. You have the 0.04 grade and you've got the 0.02. Anything that is 0.02 is basically not really viable. You'd need about $100 uranium to make
very high price to make that thing.
Yes, you would make
Bannerman,
and
looking at you.
Yes. So Bannerman is, bless their hearts.
But if we do get triple digit spot, and
if you get triple digits, I mean,
Brennan is going to look like a genius.
If you get triple digits and he's able to somehow quickly secure an offtake agreement, it's signed in like blood, that they can't back out of at all, and he gets the money up front. Yes, good, great, we're good to go. But you take a look at like, the Chinese that they bought out Husab. I mean, the the throughput on Hassab, the amount of material they're now having to push through is astronomical. I mean, it's gone way up, way beyond, I think, what anybody really anticipated would have to happen at that mine. Because I mean, you know, when what was their name? Extra or Extra or Extract, I don't know, I forgot what it was. Extract Resources, I think. Whenever they found that, I mean, it was like, you know, they were finding all these fantastic grades for, particularly for Namibia. And it was, you know, and then like 10 years later, they're having to basically like push just way more material to get the same amount of uranium out. I don't know. I mean, we'll see. It's like I said, I think what will really happen is you're going to have some deposits that are going to be found, you know, and it just depends on what kind of production you get out of Uzbekistan. Uzbekistan has an interesting soil composition. It's sort of somewhat, you know, getting the in situ to work is a little bit more difficult. If Denison can get in situ working in the basin, that's a game changer.
Yeah, that's big.
That would be huge, because that gets basically that makes like 40, 30 million pound deposits in the basin viable. That's like huge. I mean, that's like
from what I see, they seem to be on track.
Yeah, I mean, it's getting the environmental and all that other
Oof.
crap, but you know, I mean, it's if they can get it working, I mean, it's what they need to do, because they don't really have any other choice. I mean, it's, you know, they don't have a deposit that's big enough or viable enough to make into an underground mine, unfortunately. So, you know, it is what it is. But I mean, the true needs worldwide right now is probably about 130 million pounds a year, I believe. And everyone's been, if I'm quoting my pounds correctly, but basically the supply deficit is far lower than what a lot of people think it is, and what a lot of people have been led to believe. It does not mean that there isn't a bull case here, but it's timing it that's crucial. You know, it's like, you know, being a little bit patient, finding viable assets. And in particular, you know, there's the one asset I like in Canada that is owned by NXE that's going to get sold to Cameco. That's a sure thing. I mean, I can always tell you that's a probably, assuming NXE plays ball. I mean, they're going to do something stupid. They're going to try to time it so the arrow comes online, and then, you know, it's going to take some time for Cameco to develop this. But, you know, who knows? Cameco is probably going to buy it, though, because that's what Cameco does. I mean, and they're going to need assets to replace
what they've depleted. Yeah.
So yeah, I mean, and Cigar Lake is not going to last forever. Exactly. And the nice thing about this is that they won't have to have a joint venture, because I mean, it all depends on how big that deposit actually is, because it's unknown. Cameco owns right next to it. I mean, you could go look at this in proved reserves. Basically, it was the one sort of I bought it at a lower price. It's I think I'm up. Let me just check. I mean, I bought it a couple weeks ago, and basically I'm up like 14% on it year to date, so not bad. But I think it's a double essentially. So, but that's the one thing that honestly excites me in the basin. There just isn't a lot else. Because in the basin, you either have to have a case for you're going to get bought, or you have or you have to be so big that you're eventually going to be developed.
Which is going to take a long time in that part of the world.
So, I mean, so yeah, and you get like the base loads and all the other just nonsense. You know, the things that are just like, oh my God, we found, or you could be like Can Alaska, that's like way too damn deep. I mean, it's 800 meters down, I'm sorry, is not happening. It's like
it's ultra deep water, okay, offshore, but you know.
Oh, it is, yeah, because it's hydrostatic pressure down there. Yeah. So it's basically like trying to put a tunnel down 800 meters into the ocean, and it's like, you know, so it's just you're constantly fighting water ingress. And Cameco will tell you they had a hell of a time with Cigar Lake for that. I mean, there's just, that was the reason that mine flooded, because they were just trying to go deeper than really anybody has ever gone before in terms of an asset, but it was big enough that, it was worth it. But God knows it took them forever. So, I mean, we'll see. It's like, you just have to be very, very choosy, because you just have to understand that everything out there is a known quantity. And it's best to basically, it's if you can find something like I have, or like try to stick to things I have that, don't have the political risk to them and nobody is talking about it, then you're probably going to be good. But,
But when you look at the opportunity costs, as I've done, I said, well, I could do that, or I could buy some of these oil, coal, gas plays that we've been talking about. Like, you know what? Maybe I'll put a little bit of gambling money here, there, and uranium. But other than that,
I mean, I'll put it to you like this. Like, I think the uranium play is, wait, I don't know. I think it's, where did it take that? I don't know. No, that's not right. All right, it's about 6% of my portfolio is what is in uranium right now. And that's just because that's sort of the purely speculative side of things. But I mean, again, I run high risk, I run a fairly concentrated portfolio. So I'm very confident in that name, but it's what it is.
So let's talk about your style and then your publication, and then I'll have to get you back for a round two. We've been talking for 2 hours, guys, because we were chatting way before, and I could keep going, but I also have another podcast coming up, so I need to move.
Which is
how many positions normally do you run, and why do you come up with that number? And then tell us about your publication, where people can find you, and well, I'm going to tell them why they should subscribe, but you can also do so.
So I think I'm in about 7 different positions right now. Not a lot. I mean, it's just, look, I do a lot of due diligence. Like, you have to understand, like, take Petrobras, for instance. It took me like 3 or 4 months of just research before I finally came around. And it's like, okay, I'm going to buy Petrobras now. And I've been in Petrobras since pretty much November of last year. So for me, it takes me a while, and everything is backed up by just like an insane amount of due diligence. So yes, I have these, very high portions of my portfolio that are these names, but I am like, you get to, I don't want to say, let's not say beyond reasonable doubt, but it's like more likely than not on the high end that these are all going to pay off. I mean, I just understand the accounting. I understand the asset itself. I understand their business. And you just come up with, and you learn for what to look out for, what's going to change your thesis. And ultimately what I really come up with is, what I think the value is. And, I just am comfortable sitting and waiting. And so far, I mean, most of my positions this year that are all new positions at this point. Most of them are up about 10 to 20%. So
do you scale in tranches, or you just
yes, I mean, well, okay, yeah, that's fair to say that I will do that. Like, if there are some dip buying opportunities, yes, I'll if I'm comfortable doing that. And then I keep basically a good bit of spare powder sitting around, just in case.
How much cash would you keep?
Oh, probably anywhere from like 10% to 30%, basically. Okay. Anytime. But my book is very long. I don't really short much. I'm a lot of people seem to think that I was some kind of a perma bear. I don't know why. Okay. I just happen to invest in things that are cheap, and make a lot of money. So it's I don't believe in. I do not. I will buy pull forward demand or pull forward valuation, but I have to be really strongly convinced that it's going to continue to go. So, I mean, one of those things would be like First Solar. I like First Solar. I think they're going to continue to move up. I mean, and it was crazy. Solar was one of, I went into First Solar, you know, trying to hate it.
It's
And
in the
it was
too
like,
hard basket for me.
yeah. And I
I'm
mean,
not smart enough for that.
well, I mean, and I went in basically investigating them and trying to just say, I want to find something wrong with this company. And it turns out like, oh shit, like this thing is going to be $400 or $500 in a couple of years. The share prices anyway, because they have just this fantastic growth model and it makes so much sense and they don't have debt. And oh God, I like this. Yeah. So even if basically I will tell you exactly what I think, even when I want to hate it.
Yeah.
I will, you know, that's something that needs to be understood. So I give people a very honest opinion. I do not color it at any stretch. And I disclose all of my positions. So, and I, you know, the great thing about proven reserves and what I like about it, and what I like about what I do is everybody can understand it. Is I take, I do not speak in, let's see, how would we call it? The Greeks, investor AR or investment English or whatever the hell it is. I do break these things down into terms that basically people can understand, which is, you know, not hard to do if you try. And people are almost always able to read my assessments of things and they come away with it and they know exactly what that business is. And I like people to, you know, ultimately I'm not a money manager. I do not want to manage people's money. That's not my shtick. I will tell you what to buy and I will tell you, you know, where I think it's going. And, you know, I have skin in that game too. And I backed it up with a lot of damn research. I mean, there's due diligence and then there's what I do. I mean, not to toot my own horn, but I mean, I'm looking at like, you know, when I was investigating Boss, I mean, I'm going into like South Australia and looking at mining tenements and finding all sorts of just, you know, just looking at what is all around there, understanding the legal and political landscape, finding out what like recent law changes are. There isn't really a stone that's left unturned because I do not buy things unless I am comfortable like going on vacation for a week or getting a cup of coffee. I mean, there is times where I don't like to look. I mean, I have my portfolio open over here. I look at it occasionally, but there are days where that has gone down like, you know, 10% for whatever else happened, you know, something disaster. And I'm just sort of sitting here like,
the price we pay for outperformance.
exactly. And I'm just not, I am, you know, what I want and what I hope I impart to other people is sort of just a zen. Like you just don't care. It's like, you know what you own. And when you know what you own, you know what to look out for in terms of what is the actual systemic risk, what is the material change that is going to change your thesis, or, you know, you could know what you own and you're just going to sit there and like, well, okay, yeah, BTU has gone down to like, oh, wow, we're at $19. Like, okay, great. The company's buying back a ton of shares. Oh, and what do you know? We're back above 20 now. It's like, cool. I mean, I bought at like 23. I get that. It sucks. That is, BTU is the only position I'm not in the green in. I should say that. But I don't care because I know what that thing is worth.
There's the valuation and then there's the market quote of the day.
Yes. And, you know, and there's Mr. Market, as I've heard it called. I don't care. The market's stupid. Honestly, it is. And I don't trust the market to value anything. I will come up with my own valuations. I don't trust analysts to value anything. I do my own stuff. You know, I might start with something that they have, but I mean, I build my own models. I don't even really like to read reports because usually they're wrong. Or they're, you know, I was reading one on Silex the other day and it was like, you guys are like really underestimating the revenue here by like 10 times. I don't know where you're coming up with these numbers. You it's just, you got people out there and they cover probably like a dozen industries, and they just don't have time to do what I do, which is basically just, so I will go in like, so somebody, I was in silver last year, let's say, right? So I go in and I find the one silver play that is actually like, valued for the risk, which was Adriatic. And I find that I pretty much buy it at the bottom. Unfortunately, I didn't hold it, but it's fantastic opportunity. And, and it just, and that's what it takes. I go through, I don't find the first thing, don't buy the first thing I like. I will look around, and I will, there's just certain things. It's hard to say, basically what I guess you could say my process is, but it really comes down to understanding the business, mapping out the business as to what exactly they do. What are other people not necessarily understanding here? Because almost always there is a lack of understanding, particularly in like the resource business or something like New Fortress Energy, or even something like Petrobras. Like a lot of people think like, oh yeah, Petrobras, Brent's gonna go up and we're gonna make a lot of money. Petrobras makes their money from selling gasoline and diesel.
Yeah, refined product, guys.
It's not, I mean, everybody sort of kind of had the idea that it was like just the pre-salt oil. No. We make our money by basically selling gasoline and diesel, which is why I want them to make more refining capacity, because then we can export it.
Product, yeah. Exactly.
So
to a thirsty world.
Exactly. So, it really comes down to just really thoroughly fundamental evaluations that de-risk what looks like incredibly risky investments. Like,
And the only place,
and
the only way you can get to that place is by doing that insane amount of work and due diligence.
There is honestly, it's sort of insane just how much I do. And
that's what's on offer in your subscription service.
Yes. Which is very, reasonably priced. Mind you, it's like, I think I'm charging like it's asking like $30 a month. It's not much, folks. And look, if you just want to sign up so I can send you emails, I can advertise to you and you can eventually sign up when I have some article that, you want to read, it's fine too. I like having an email list. It's great. So, but it's, I try to keep to a good publication schedule. That's how it goes. But I mean, there's a little bit of quality over quantity there. So I do try to remember to publish things pretty well, pretty often. But what you will find there is it's pretty good, and I very rarely miss. Basically, if it's published, it's probably going up. In terms of, I mean, past performance is no indication of performance. Do your due diligence, blah, blah, blah. It's not investing advice.
But
I get it. But ultimately it's not investing advice, really. I don't like to think of it as investing advice, because I'm just trying to help you understand it. Exactly. Because I'm not going to be there to babysit you. Honestly, when something happens or there's some piece of news, you need to understand that, because you may not be able to reach me and I'm not your money manager.
Correct. You may be able to outsource research, but you can't outsource conviction. So when push comes,
which I have a lot, and everything I have is, exactly, and it's a desire to impart that conviction to people. I mean, I don't want to just keep everything. I mean, I don't talk about everything, obviously, and there's certain things that I am slowly but surely learning. I mean, obviously, we've been on this conversation for a while. I clearly like to hear myself talk, but I am slowly learning to pull back and keep some of the stuff. And there are certain things that I just disclose just solely on the Substack. And I don't talk about them publicly because I just don't want them known. Like I'm not a pumper. People need to understand that. I am not going to go out and basically try to get a stock to go up to the damn moon, because why would it would not help me at all if Peabody is suddenly $50. I want them to continue buying these shares back from these stupid idiots that are selling every day.
Effective percentage of ownership.
Exactly. I am buying back these people at like 2 times earnings, 3 times free times cash flow. It's like,
thank you very much.
Okay, I'm not going to tell them otherwise. I'm not going to. be my guest.
Yep.
Sell your
You-
damn
you-
shares.
yeah. Well,
You
this has
know?
been a fascinating conversation. We definitely have to catch up again, guys.
Yeah. Oh,
Links
yeah.
to Chapman's Twitter will be in the description, as well as the Proven Resources publication. Check it out.
Reserves, proven reserves. Sorry.
Proven reserves.
We don't have resources. We have reserves.
God damn it.
It's fine. I mean, except on April Fool's Day, which I think I was going to go to. The joke was I was going to have indicated resources or something, or inferred assets, or inferred resources,
P3 or something like that. Yeah.
Yeah. So
No,
I mean,
I look forward to catching up with you guys. Take care. Do your own due diligence, and I look forward to catching up with you in another video episode of the ROI channel shortly. Take care, guys. Bye.